All right, let's dive into one of my favorite signals in all of trading. We're talking about the bullish engulfing pattern. It's a classic for a reason, a powerful sign that a comeback might be just around the corner.
I mean, that's the big question for any trader, right? You're watching a stock fall, and it just feels like you're trying to catch a falling knife. How in the world do you spot the bottom before it's already in the rearview mirror?
And this leads us right into the trader's dilemma. Picture this. You've been eyeing a stock, you really like the company, but it's just been bleeding out day after day. You want to buy so badly, but you're just paralyzed, asking yourself, is now the right time?
To really get this, you have to think of the market as a constant tug of war. It's a battle between the buyers, who we call the bulls, trying to push prices up, and the sellers, the bears, trying to drag them down. And in a downtrend, well, it's not even a fair fight. The bears are just running the show.
But here's the cool part. Even when things look their worst, when it's just a sea of red candles, the market has a way of sending clues. Little signals hidden in all that noise, hinting that a massive power shift is about to happen.
So let's set the scene. On day one, everything is business as usual. The sellers are still in charge, no question. The price grinds lower all day and it closes down, forming a bearish red candle. It pretty much confirms what everyone's thinking. The downtrend is still on.
But then, day two happens, and it is dramatic. Out of nowhere, the buyers storm the castle. The price might even open a little lower, but then, bam, they come in with so much force that they drive the price way up, forming this huge green bullish candle that completely swallows the red candle from the day before. It's like a knockout punch. And that, my friends, is the bullish engulfing pattern. It's this two-day story told in candlesticks. You have this big green candle that totally engulfs the body of the little red one before it. Visually, you can't miss it. It's a powerful sign that the sellers have lost control and the buyers are now in charge.
But hold on, it's not just about spotting a big green candle next to a small red one. If you want to use this thing properly, you've got to know the specific rules of the game. So let's decode what makes a true bullish engulfing pattern.
There are 4 boxes you have to tick, every single one. First, the pattern has to show up after a clear downtrend. Makes sense, right? You can't have a reversal if there's nothing to reverse. Second, that first candle has to be red, showing the bears were still in the game. Third, and this one's kind of cool, the green candle needs to open lower than where the red one closed. It's like a final head fake for the bears. And fourth, the body of that green candle has to completely swallow the body of the red one. Not just match it, engulf it. Total domination. Okay, so you've ticked all 4 boxes. The pattern is confirmed. Does that mean you bet the farm? Not so fast. The smartest traders know that one signal is just one piece of the puzzle. You gotta look for confirmation to stack the odds in your favor. And here are 3 great ways to boost your certainty. First, look at the trading volume on that big green day. Was it huge? A massive spike in volume means there was real conviction, big money behind that move. Second, think about the market's personality. Is it super volatile right now? Because in a crazy market, big candles can happen for no real reason. And third, look for backup. Do other tools you use, maybe the RSI or a key moving average, also suggest a bottom is forming? It's all about building a case. All right, so let's get practical. You've spotted the pattern. You've found some confirmation. So now what? How do you actually turn this pattern into a potential trade? Here's a perfect little story. A trader, we'll call him Michael, he sees this exact pattern on a stock he's been watching fall. But he doesn't just jump in guns blazing. No, he waits one more day. He wants to see if the price keeps going up, to confirm the reversal is real. It does, so he buys his shares at $10. Later, he sells at $13, pocketing a nice $1,500 profit. That one day of patience, that was everything.
But what if it had gone the other way? What if Michael was wrong? Well, this is where being smart about risk is absolutely non-negotiable. Most traders will place what's called a stop loss just below the lowest point of that big green engulfing candle. It's your emergency exit. If the price drops that low, your trade automatically closes. It's a safety net in case the signal turns out to be a false alarm.
Which brings us to the million-dollar question, doesn't it?
the promise versus the peril of this pattern. When it comes right down to it, how reliable is this thing, really?
Well, the numbers are actually pretty solid. The research tells us that, historically, after this pattern appears, the price goes on to close above the high of the pattern about 63% of the time. Now, that is not a guarantee, it's not 100%, but what it is a statistical edge. And in trading, an edge is everything. So let's break it down, the good and the bad. On the plus side, it's fantastic for spotting potential trend changes, and it gives you a super clear entry point and even a logical place to put your stop loss. The downside? It's not perfect. It can definitely flash false signals, especially if the trading volume is weak. And here's the big one. It doesn't give you a price target. It tells you the trend might be changing, but it gives you zero clues about how high the price could go. So at the end of the day, you got to remember that this pattern isn't a crystal ball that tells you the future. It's a clue. Think of it as the market tapping you on the shoulder and saying, hey, pay attention, something just changed. It's not the answer. It's the thing that prompts you to start asking better questions. The signal is there. So what's your next move?